why should anyone typically think about retirement at the age of 25?
For every single day of delay that you are making in starting to save for your retirement, you're losing 1,586 rupees.
Is it fair to keep 40% even after your retirement non-withdrawable?
The product should be such that there is a certain minimum amount of cash flow that has to be guaranteed for the rest of the life of the individual.
So do you think that NPS contributions by the employer or by the employee himself should be made compulsory in the private sector as well?
As an employee, I can tell my employer that, listen, cap it at 12% of 15,000.
Today we have Mr. Sriram Iyer, the MD and CEO of HDFC Pension. HDFC Pension is India's leading private pension fund manager with over 40% market share. It manages over 1 lakh crores in NPS assets. With nearly 3 decades of experience, Sriram brings a deep understanding of investment products. In this episode, we will understand his perspective on India's retirement gap and the cost of delaying retirement planning. He also highlights why NPS stands out as a low-cost, flexible tool with tax benefits. Hi Sriram, good afternoon. Thank you so much for being a part of our Speaking with Stalwart series at One Finance Magazine. It's a great pleasure that you are here. I'm excited for the talk.
Thank you very much. It's my privilege too.
So, speaking of the retirement problem, why should anyone typically think about retirement at the age of 25? And largely, if we have to understand the retirement problem that is there at hand in India, what's your take on it?
Sure. I think firstly, I want to clarify that retirement is not a problem. Retirement is something that people look forward to. But I do understand that at the age of 25 or for youngsters, it's a milestone which is way ahead, which is way 30, 35 years away in life, right? So to that extent, it is obviously something that is not top of the mind as far as an individual is concerned at that age, right? But I think the important factor to note is that, and everybody understands power of compounding. I don't want to go down that path. But the reality is that the sooner you start putting money aside, the larger is going to be the corpus. So that's the reality, right? That's how compounding works. That's how markets work. And therefore, it is important for one to realize that with every passing day, you are losing out on that milestone corpus just by delaying it by every single day. And we do various awareness sessions and seminars on NPS and retirement per se, and we put out these calculations saying for every single day of delay that you are making in starting to save for your retirement, you're losing 1,586 rupees, right? Stuff like that to make it compelling for somebody to start taking a look at this a lot more seriously. That's number one. Number two, what does money do to you, right? If I were to borrow Morgan Housel's phrase, he says money buys you freedom. Right? Essentially, how much money do you need? The money that you need, which can make you feel free to do what you want to do, right? So if you want to start doing what you want to do, and maybe you want to pursue passions, hobbies, and so on and so forth earlier on in life, instead of waiting till the age of, let's say, 60 or 65, starting early is always a good idea because it will give you the freedom much earlier. And therefore, you might start on this whole FIRE movement that we all are familiar with. One may agree, may not agree with FIRE, the retiring early, the whole funda around retiring early. But the reality is that it does force you to start saving at an early age so that you have the freedom to do what you want to do much earlier in life. And therefore, it gives you far more flexibility and freedom. I think that's one of the reasons why I think one should start considering. Finally, I want to make this point about saying that, this whole this belief that if I have to start, I have to set aside 20% of my salary or 10% of my salary. It couldn't be farther from the truth. All you need to do is to take the first step, right? And as a famous Chinese philosopher said, a journey of 1,000 miles begins with the first step. All you need to do is to take the first step. And the first step is to start the process of setting money aside in a product which can potentially make you a significant corpus at the end of whatever is the tenure that you want to save for. So I think that should, in some sense, shine the light on why one should consider starting to save for retirement at an early age.
So speaking of numbers, if you have anything around what's the average age of Indians, or maybe the average age until retirement that we have, what are the number of years and what is the corpus required, how much are people saving, will that be enough or not? So if you can shed some light on that.
Certainly.
The retirement gap in India right now.
Sure. So if you look at the numbers, right? So the retirement gap technically is, for a country, a retirement gap is defined as the amount that the person ought to have versus what they would have ended up saving, right? And that number for India is a number which is mind-boggling, which is actually $96 trillion, right?
Gosh.
It's a very large number, right? Let's not even go down that path, right? So it is indeed a problem. So I'm not trying to sort of belittle this. I was just sort of, trying to categorize retirement as an opportunity and not really a problem. From that perspective, I was saying it's not a problem, but it indeed can turn into a serious problem if we don't take adequate steps to address this over the next few years that we have. Coming back to your question on the age profile and so on and so forth, India is an incredibly young country. I think all of us know this. The median age is 29, which means that there are 70 crore Indians, or maybe 74, 75 crore Indians now who are below the age of 29. And of course, equal number above the age of 29. But the number that I think we need to keep in mind is the number of people who are about the age of 60. That number, by estimates, by reasonable estimates, what we understand is that there are in excess of 12.5 to 13 crore people in India who are above the age of 60, right? This number over the next 25 years will double, right? Which means that there are going to be 25 crore Indians who are going to be above the age of 60. Why is it important? Why is it that we need to be worried about the fact that there is going to be a large number of people who are going to be above the age of 60 or even 65 for that matter? And we all know the experience from developed economies and aged economies, like for example Japan, right? Japan is dealing with a serious problem of old age. The challenge is, as one ages, productivity comes down, and therefore the young population of the country will have to start fending for the old. The young will have to start funding and fending for the old, right? That's the reason why it is important for us. We are in a very sweet spot at this point of time. We are still sort of reaping the so-called demographic dividend, but that's going to change. And therefore, we need to be very conscious of the fact that with every passing year, this number is moving, right? And therefore, this can become, and 25 to 30 crores is equivalent to the population of the United States today. 33 crores is the population of the United States today, right? So India will have 60 plus age group, which is equivalent to the population of a bunch of countries in Europe, or probably the size of the US population. So it's a fairly large problem that can snowball into a large problem if we don't address it, right? So that's as far as the age issue is concerned. Now, with respect to what is the right figure, when it comes to how much should one have, it's going to depend on numerous factors, right? But I think what we need to be conscious of are two things, right? One is the fact that the nature of Indian families have changed, right? And I'll give you some numbers, right? In 83, 84, the size of an Indian family was around 5.3 or 5.4 in terms of the number of people in a family, right? That number has dropped to 3.2, right? Now, this is just a number, right? What does it really mean? And we are all, all of us have experience, right? All of us know people around us who used to live in joint families, right? With the entire family, the brothers and the spouses and so on and so forth, and the parents are all staying in one big joint family, right? That's changed. And that's changed on account of urbanization, that's changed on account of cost of living, that's changed on account of the fact that everybody has aspirations which may be different, right? So families have become a lot more nuclear, right? And that is going to increasingly happen, right? I mean, I have a family of 4 with my daughters, 2 daughters, and my parents and my wife and I, 6 of us, right? But I know that in no time are they going to be on their own, and they are actually on their own at this point of time. So really, we are all much smaller, and which means that the unit has to self-manage, right? Which means that this whole large joint family thing used to make sure that people are able to sort of cross-subsidize each other, right? And therefore, that used to sort of, that one big unit was a self-sustaining unit. That unit is becoming smaller and smaller, right? And therefore, you have to fend for yourself in some sense, right? The other big thing that's happening is that the number of years that one will survive has gone up significantly, right? So, official estimates now suggest that mortality in India is around, I'm told, 72, 74.
Right.
But I think, if you look at the segment, if you look at India and Bharat, right? by which I mean the affluent India and the lot more, let's say, let's say not so affluent India, which is Bharat really, right? So the rural and the urban, if you were to look at it, the mortality rate amongst people in the higher segments of the society has gone up significantly, right? Which means that beyond 60, you need to be able to survive, not just survive, but also lead a life which is comfortable for you, because medical expenses and so on and so forth are going to only keep, burgeoning, right? If you look at medical expense, inflation is in the region of 13 to 15% per annum, right? I mean, every single procedure, every 4 or 5 years, you will see that the cost is doubling, right? So all of these things will mean that, and these are all multitude of factors that I sort of told you about, right? Now, what does it mean? What does it mean in terms of what should you have, right? And, I'm sure you're familiar with the whole withdrawal rate equation that typically gets used in the US, right? I mean, more in the US than in India. 4%, right? Which means that essentially you need to have 25 times of what your annual expenses are. I think that number is underestimated, in my opinion.
In India, at least.
In India, it is definitely underestimated. And, one could also factor in the fact that in India, you may probably make slightly more, but you also need to keep in mind that the inflation is a lot more here as well, right? And therefore, an inflation for discretionary spends as well as spends like medical is significantly higher,
right?
As one ages. And therefore, the quantum of expenses that is inflating at 14-15% is much higher, right? And therefore, this 4% may not really work out, right? So therefore, I don't have a straightforward answer to say that you need to have 25 times or 30 times of your annual expense as the kitty. Different strokes for different folks. I think it requires a lot more, get involved in this discussion with an advisor before you're even able to come to a conclusion, right? So we did a survey 2 years back, right? I mean, last year we did a survey on retirement savings in India and attitude towards retirement savings in India. And we, of course, did this with NPS as one of the focus. It's very surprising that a number of people felt that 1.2 crores was an adequate figure for them to retire. Now,
in tier 1 cities?
Yeah, it was largely a tier 1 focus survey. The respondent, there were some 3,000 odd respondents, right? So, I mean, it just tells you that people are severely underestimating, all of these issues that could potentially, so people are worried, right? But what happens in India, and I've seen, this again, anecdotal evidence, is that when you meet with people, especially when they're closer to retirement, is when they will say, now how should I plan for my retirement, right? That question you need to ask at the age of probably 30, 35, right? Because you're able to make some changes in the way you approach this whole milestone. Right. But it's an evolving situation.
Got it. So if we speak about, since you spoke about your survey as well, let's talk about tier 1 cities.
Mm-hmm.
Within tier 1 cities, what do you think is an adequate number of retirement corpus? Since you said 1.2 crores, which is of course not adequate. Let's say someone with current expenses of 1 lakh a month before retirement. Of course, after retirement, your expenses also, reduce.
Come down. I mean, you can assume a 30% reduction, 25 to 30% kind of a reduction,
so
which is what, there's no perfect science around all of these things. But yeah, you could assume a 25 to 30% reduction in your expenses, and therefore maybe 25,000 to 80,000 rupees.
Right.
But what you need to keep in mind is that this whole, this inflation issue that we spoke about, right, is something that is real, right?
It can be covered with health insurance?
It can be, provided you have taken the right steps at the right age, right? At the age of 60, while I think the Supreme Court recently ruled that you can't deny insurance to a 60-year-old person, but ultimately market forces will take over.
Right. Absolutely.
They may offer an insurance, but it may be very, very unaffordable, right? And therefore you may not be able to buy it also, right? So therefore, if you've taken the right steps, by which I mean if you bought outside of your company, so-called company medical cover, if you bought a cover, if you bought a top-up, you bought a super top-up, you're good. Right? But of course, that premium also will keep going up, right? Every 5 years, the premium keeps going up, right? It's not as if it's a level premium like in term insurance, right? So to that extent, medical can potentially be partially be covered. But again, if you look at the penetration of medical insurance in India, it's also abysmally low, right? So to that extent, Indians are also very, very undercovered from a medical perspective, right? So if you were to coming back to the question that you asked, right? Let's say 75,000 rupees per month is the number, is your expense, right? Today, that could potentially be 1.5 lakhs 10 years from now, right?
Correct.
7-8%.
At least,
It'll be at least 1.5 lakh, right?
Right.
So if you were to assume that you're going to survive till the age of, let's say, 85 or 90, I think the math, we can sit and do the math, but that number would definitely be your annual expenses multiplied by 30 to 35 times, right? At least. right?
So 35 times your
At
annual
least,
current
right?
expenses.
That's the kind of number that you will need to keep in mind. But also keep in mind that, people's aspirations change, right? People are becoming a lot more adventurous at older ages, right? They want to do things which they have not done in their youth, so to say, and things that they are able to do. They may not be unable to go, and some of them end up doing things which they wouldn't have possibly attempted at the age of 45, but they end up going for a very strenuous trek, and these things cost a lot of money, right? So I think there is no one right answer for this, but I think I would be not way off the mark if I said that 30 to 35 times of your current annual expense is something that you should certainly keep aside, so that you are at least somewhere in the ballpark, right? And I think the other myth that typically sort of that I keep hearing about is that, I'm close to retirement, or I have retired and therefore I need to put all my money into fixed income, right? Nothing could be farther from the truth, because if you are going to live for 30 years and you're not going to need all the money in the first 2 years, first 3 years, 4 years, 5 years, 7 years, and if you assume that the probability of making double-digit returns in equity goes up beyond 7, 8, 9 years, then there is a case for you to allocate some money there, right?
Right.
How you participate, in what form and shape, I mean, the advisor is best placed, the person who's working with the individual is best placed, but I think there are ways to sort of manage this whole piece such that your money doesn't outlast you, which is really the biggest concern that most people have, right? My money shouldn't outlast me. If I end up in penury at the age of 85, what do I do? Right? It's a big fear.
So 35 years is what you said. And how much is the actual number as per your survey or whatever studies that you have in your
So the survey essentially tried to assess two things. It tried to assess what are people's, how do people approach retirement, right? What are the kind of products that they look at, right? There is fixed deposits, there is mutual funds, there is insurance, there is NPS, there is EPF, there is PPF, and so on and so forth, right? So familiarity around these products, right? And what is your attitude towards retirement, right? And what are the kind of estimates that you have with respect to saying, okay, how much do we think? So and of course, awareness around NPS, right? I mean, as to how much do you know about a product like NPS, right?
Right.
So that's what we attempted to do. This was a year and a half back. We will do the second round in the coming year. And hopefully, some of those metrics would have changed in terms of awareness and adoption.
So let's not talk about this survey, but other studies that are in your access. What is this number? If not 35 years, then where are we?
What do you mean by 35 years? You're saying
35 years of current
expenses. So India, if you look at
Tier 1 India.
Tier 1 India, there is a huge wide variance, right? And again, anecdotally, and we meet a lot of people because we work very closely with corporates, right? And therefore, we get an opportunity to interact with retirees from these corporates, right? And when I say corporates, a large number of them are public sector undertakings, right? By the way, public sector undertakings traditionally in India have been very employee focused, right? They have a very good employee benefit scheme, right? For instance, medical is taken care of in a number of these PSUs. Medical is taken care of for life of the employee, right? And for the employee of the spouse, life of the spouse as well, right? Despite that, you will see that there are broadly 2 or 3 sources from where the corpus ends up getting built. One is the employee provident fund, right? Which all of them would have been contributing to for their lifetime, 25, 30 years, 35 years in most cases. That typically ends up being a pot of around 2 to 2.5 crore. At a middle management level, if you retire at a middle management level, you would have around a pot of 2.5 crores if you have not withdrawn anything along the life of your employment, right? If you withdrawn something, then obviously it sort of takes a hit, right?
Which obviously people do for their kids' education.
Well, not so much. So much. I think with education loans getting more and more popular, and the fact that interest on education loan is fully tax deductible without a limit, people understand that. And with accessibility of education loans becoming better and better, I think people look at that as an alternative. Of course, some people do draw upon their EPF for, let's say, building a house, for instance, right? Buying a house, so to say, in a place like Bombay where costs are very, very high. Spoke about that. People do end up withdrawing. But having said that, that's one big corpus. The other big corpus potentially is NPS or superannuation, as the case may be, right? Typically, this is the structure in a public sector undertaking, right? In private sector companies, superannuation is a very, very few legacy companies have superannuation as a product, as an offering for their employees. Most of them have allowed employees to cash out, by which I mean that if the employee chooses not to contribute to superannuation, then the money would essentially go back to the customer, to the employee in the form of tax deducted money, right? I mean, the money tax would get recovered and the money would come to you in salary, right? So typically these are two big, sources of income as far as sources of, let's say, corpus creation as far as individuals are concerned. And then there is some investments that people would have made along their lifetime, right? Now, very difficult for me to tell you what is that number, but in very, very few cases, maybe 5 to 10% of the people that we meet, and this is all anecdotal, so don't hold me to it, is the number anywhere in this ballpark, right? More often than not, people are underprovided for retirement, and the next generation is really their investment in retirement, right? Their sons and their daughters who have to look after them. I mean, that's how it was at some point of time in the past, right? Your next generation was your retirement savings, right? But so that, I think, but it's changing, right? I mean, in 5, 6 years from now, 6, 7 years from now, I will retire, right? But I'm in a much, much, much better position, right? Because of the fact that, I've had the privilege of working with certain organizations, being exposed to various things, because of which, I'm able to sort of, my situation would be dramatically different from what my father's situation was, right? So that change is happening for sure.
Got it, fine. So speaking of retirement products and pension products, both of them, I know the two are different. Which all products are available in this category in India, which are famous as well? Like, I won't talk about very, like, we can talk about underrated products, of course, but not something like a very small a very small product which has like a very minuscule AUM. Let's not talk about such products. We all know then the list will never end. But otherwise, which all pension products do we have in India, and retirement products for retirement planning?
So when it comes to pension products, and I think, in my own experience, when I talk to people, there's a huge confusion between pension products and annuity, right, or pensions, right? Now, what are pension products? Pension products are products which are offered largely by insurance companies. I mean, insurance companies have largely been the primary sort of manufacturers, if I were to use that word, of pension products, right? And these pension products were very popular till the year 2010, after which it sort of lost its flavor, and then it has sort of come back in the limelight in the recent past because of the tax changes that have happened on the traditional products and on the ULIP products, right? So when you look at pension products, what are pension products? They help you accumulate a certain corpus. NPS, in some sense, by that yardstick, is a pension product, right? Where it helps you accumulate a certain corpus which is available to you at the time of retirement, right? That's really a pension product, right? Now, therefore, if you were to look at all the, the wide array of products that are available to help you accumulate for the purpose of retirement, the largest out of this is obviously the Employee Provident Fund, right? So the Employee Provident Fund organization, which manages EPF, the total AUM, give or take, is I think around 26 lakh crores today, right? That's the widest coverage in terms of subscription by the formal sector. So the formal sector, I mean, there is a rule that you have to, if you've got at least 15 employees, then it is compulsory for you to sign up to Provident Fund, and you need to contribute on behalf of the employee towards the Provident Fund. So it's a compulsion for people to contribute towards Employee Provident Fund. So that's the largest corpus. So that's around 26 lakh crores, right? Then comes the National Pension System, which is the NPS product that, that I'm involved in, and that's a part of the industry that I am in. That is around 14 lakh crores now. So that makes it, between the two of them, is around 40 lakh crores, right? And then there is, of course, this 14 lakh crores is a combination of government employee contributions and assets under management and private citizens' monies as well. So it's a combination of the two. So 14 lakh crores, 26 lakh crores roughly, that's 40 lakh crores. And then there are superannuation funds. Now, the size of the superannuation fund, there is no formal source for really determining what the number is, but my estimate is that it will be around 4 to 5 lakh crores, right? While it has sort of depleted significantly over the last few years, because one, companies have decided to sort of move to NPS vis-a-vis superannuation, because superannuation also requires you to maintain a trust.
At a company level.
Administratively, it is, yes, at a company level. Administratively, it is a lot more complicated. It's expensive to sort of run a superannuation fund, and superannuation funds traditionally have in the past largely invested in the superannuation fund that typically gets managed by insurance companies, LIC and the like. Even HDFC Life obviously manages superannuation funds for some of its customers. But, the returns there, given the fact that it is managed conservatively, have been in the region of 7 to 8%, right? There are some unit-linked products which are slightly higher than that. But by and large, superannuation fund, because it's retirement money, tends to get managed very, very conservatively. It's very counterintuitive, but it gets managed very conservatively. But that corpus is actually shrunk. So if you look at the total corpus of money that is there in this whole so-called retirement ecosystem, employee provident fund, national pension system, superannuation, then there is the public provident fund, right? The public provident fund is only 4 or 5 lakh crores, which is meant for people at large, right? If you're a self-employed individual, you could invest up to 1.5 lakh rupees in one person's name. And that's available to you at the end of 15 years, and you can keep extending at with the 5-year extension and so on and so forth, right? So these are basically the four products which are really the most popular products, or the product where you will see money is being set aside for the purpose of retirement. Insurance companies, the pension plans that I spoke to you about, it's not a very large corpus sitting there. I think it's in lesser than 1 lakh crores, right? So it's not very large in that context. Mutual funds also offer retirement plans. That again is a very, very small, minuscule number compared to the numbers that we spoke about. So between the insurance sector, the mutual fund sector, and then there is these 4 products that we spoke about. So this is really the bouquet that is available to an individual to save for retirement as a specific goal, right? So that's really the product architecture.
Got it. While if you talk about EPF and PPF, largely the investors get a fixed return, right?
That's correct.
Leaving them aside, which is the cheapest form of retirement or a pension product that we have in India today?
So clearly NPS stands out. I think the answer is pretty obvious. And I think we all know what the pricing structure around NPS is. NPS, when it was started in the year 2004, and the genesis of that is obviously if you're familiar with the Project Oasis, the committee that was set up in 2000, and then the report was published, I think, in 2002 or so. That was the genesis of NPS as a product. And one of the key considerations of that product was that of that report, of the committee's recommendation, was that it had to be a low-cost product, because we all know that there is a significant leakage that happens in the form of cost over long periods of time, right? So the terminal value can be 15 to 20% lower if your cost of managing the money is 1% higher over a 25-year time horizon, right? So it's a fairly large impact, and the way returns compound, costs also compound, right? So it works both ways, right? It's a double-edged sword, right? So to that extent, I think given the fact that at that point of time, it was recommended that it needed to be a very low-cost product. The structure of NPS is an extremely, extremely low-cost product. The fund management fees are between 0.03% and 0.09%. It's a function of the size of the AUM that is managed by the fund manager. Very similar to, let's say, a mutual fund industry where there is a sliding scale. Here also there's a sliding scale in terms of the amount of fees that we're able to extract from the fund. So at our size of roughly 1,26,000 crores as we speak, we can charge 5 basis points, which is 0.05%, right? So that's what we can charge from the charge as fund management fee from the fund that we manage. For active management. So this is active management. This again is something that underwent a change, right? Till around, so the original recommendation was that it would be a passively managed fund, right? It would sort of mirror the index. But along the way, changes happened. This product has evolved. So we manage as pension fund managers, all pension fund managers. There are 10 of us at this point of time. All 10 of us actively manage, equity, corporate bonds, government securities, fixed income and equity essentially. So 3 to 9 paise is the fund management fee. And then there are some minor fees that are associated to account opening and maintenance and so on and so forth. But fully loaded cost, and this is a study that we did, and then there was also a PFRD driven study that was done. The total fully loaded cost for somebody who stays in this product for a 25-year time horizon is less than 13 to 14 basis points per annum, right? So it's by far the cheapest product. And keep in mind that this is also the most transparent product, right? By which I mean, as a subscriber, you know where your money is getting invested till the last rupee every single month, right? So various things, but I think to your question on what is the cheapest, this is clearly the cheapest accumulation product that is available in the industry. By the way, globally also this is the cheapest product. Right? I don't know of any other country which offers an accumulation plan which is so cheap.
Got it. So globally also it's that cheap. Got it. We'll come to this question of, global pension systems and all, and where does India stand. But before that, since we spoke about expenses, insurance products, life insurance products, or as investments or mutual funds are aggressively marketed by, top celebrities, probably because they can charge higher expense ratios. But NPS largely, of course, it has gotten famous by advisors or word of mouth for it being such a fantastic product, low cost product. It has gotten the kind of virality it deserved.
Yes.
But still, it is not anywhere close to, if we talk about in terms of AUM, close to life insurance or mutual funds. So, is this the low expense ratio that is being charged, becoming a deterrent for it to become, an industry leading product like mutual fund or maybe say like a life insurance product? Both of them are close to 70 lakh crores in terms of AUM, right? While NPS, despite being compulsory for government employees since 2004, is just at 14 lakh crores. Do you think this is the reason?
That's a fair comment, right? But I think we need to look at what is the objective of the product that we are talking about, right? So National Pension System, when it was, when it was set up in 2004 and it was set up for government employees, the primary objective was to, drive it for adoption amongst the government employees, right? So the central government employees were essentially offered this product in from Jan 1, 2004. This product became compulsory for all government employees, right? So I think if you look at the economics of this product, the way it has been structured, and I can say this with a tremendous amount of conviction, there is no other product which is as client-centric as NPS. And I've said this over and over again till it comes out of people's ears, but the reality is that this is indeed the product which is the most client-centric product. I can't think of a better accumulation product. Now, given the fact, and why is it one of the best products? Cost certainly is one consideration. Other than cost, there are numerous other features and benefits that we can talk about at some stage, which make this a very, very powerful vehicle for helping individuals build their corpus, right? Now, it's a balance that we need to strike. The way the government thinks or the way the regulator thinks is that, after all these years, there are only 67 lakh, non-government employees who have actually adopted this product, right? Now, is that an opportunity or a problem? We look at it as an opportunity, right? And I think the people at large have woken up to the fact that this is a very, very powerful product. For us, for people like us, at the scale at which we operate at this point of time, we manage, as I said, close to 1.26 lakh crores across 25 odd lakh subscribers. It does make sense for us to, of course, set aside some money for marketing. It is nowhere compared to what it is in the case of actively managed funds like mutual funds or insurance companies. It's a matter of striking a balance between how attractive do you want the product to be for the end customer vis-a-vis your ability to promote it, right? Do we have a scope for us to improve on that count? Most certainly, the regulator keeps looking at this product, the government keeps looking at this product and keep re-looking at, how this should be structured so that we're able to strike a balance between able to sort of take it to the masses, at the same time keep it very, very attractive. I think that's a balancing act. At some point of time, it used to be 0.01%, right? So it's changed, right? And we are hopeful as an industry that it will change. The government will be seized of the fact, the regulator will be seized of the fact that, there is some money that needs to be put on the table for this product to be promoted. Not necessarily by celebrities. I mean, we are very happy if celebrities can join them, because this is really, in some sense, public service, if you ask me, right? Because this is a product which really can change people's lives if they adopt it at the right age, right? But I think what's really happened over the last 2 to 3 years is that the regulators have played a very, very active part. Our regulators, PFRDA, Pension Fund Regulator and Development Authority, and they take the development piece very, very seriously. And, of late, you would have seen billboards in airports talking about NPS, right? And hopefully, we will be able to do more of this. But yes, we do get, there are limitations in terms of how much we do, because we want to keep the product very, very client-centric.
Got it. Fair enough. So do you think that NPS as a product will be able to beat mutual funds or, life insurance AUM in, say, 10, 20 years from now?
See, I don't think it's a competition. Okay. Really, it's about coexistence, right? Because each of these products play a part in the client's portfolio, right? While I do believe that NPS forms the bedrock, should form the bedrock of a client's portfolio, the reality is that you do need mutual funds. You do need, because the variety that it offers, the ability that it offers, it does offer liquidity because it serves different other needs of the customer, right? You need insurance. Of course, you need insurance. Insurance can play both the parts for you. It can provide you protection. At the same time, it can also help you, with longevity, the risk of longevity, living too long and living too short, right? I mean, there's no other product which can actually do that. And insurance is, by the way, the only product which can actually guarantee returns in the long term, right? So each product has a place in a client's portfolio. It's like a thali, right? I mean, you need to have all kinds of products. And to that extent, I don't really look at this as competing. We would love for this product to get adopted by more and more Indians. And therefore, as a result of that, if it gets larger than mutual funds and insurance, we'll be very happy. Otherwise, I think every product, as I said, needs to find a place in a client's portfolio. And I think both these sectors have done exceptionally well, served customers exceptionally well.
But what's your view? Will it outgrow in the next 10 years?
Well, my boss keeps telling me that, when are you going to cross the parent company's AUM? And I keep telling her that, very soon we will. And we are at this point of time, we are at, close to, I think, 1/3 of their size.
That's also very nice.
3 years back, we were probably 15% of the size. So we've doubled in terms of percentage terms in the last, more than doubled in the last 3 years. Our AUM has grown by 5 times in the last 3.5, 4 years. So it's been a fairly, and hopefully this growth will continue, because we are at really, really nascent stages, if you ask me. We've not even scratched the surface.
Got it. So since our audience largely consists of advisors and industry leaders, 2 questions on their behalf are that, is it fair to keep 40% even after your retirement non-withdrawable, non-commutable, as you say that? Is it fair for customers, or they should have a choice for their money?
Well, I think there are different schools of thought on this. My view, and I'm saying this after having been in the industry for 3 decades, having seen all kinds of investors of different sizes and shapes and textures. See, what does this do, right? At the age of 60, it forces you to buy, not necessarily at the age of 60, because you can continue to hold the account, continue to invest in NPS beyond the age of 60 up to the age of 75. So actually, the 60 is really a bit of a misnomer, because it's really meant for people who retire at the age of 60, and at that point of time, it is made available to you to sort of commute and annuitize, as the case may be, right? I think what's important for us to keep in mind is that why is it that this 40% annuitization was made compulsory? And again, I'll go back to the OSS committee report. They essentially said that the product should be such that there is a certain minimum amount of cash flow that has to be guaranteed for the rest of the life of the individual, right? Now, you and I may be sophisticated investors, and therefore we don't attach too much value to the fact that you have to necessarily buy an annuity. But look at 98% of Indians today, right? They are financially not as literate as one would need to be. I would not call them financially illiterate, but I would say financial literacy is poor in India, right? And therefore, what ends up happening is that by forcing their hand to buy a product like an annuity, which, by the way, as we speak, the annuity rates on NPS, if you're retiring from NPS and if you're buying an annuity from NPS, the number is around 6.6, 6.7% for a return of purchase price plan, right? An annuity plan where the purchase price will go back to the next of kin on the demise of the individual, right? The rate is around 6.6, 6.7%. One could argue that, boss, if I were to invest in a fixed deposit of 5 years, I will get 7.5%. But it's a 5-year product, right? Annuity is the only product which will make sure that you continue to make the 6.7% on your purchase price for your lifetime and for the lifetime of the spouse, till the spouse is alive, right? And then the corpus will go back to the next of kin without any transmission loss. It's tax-free, right? Now, that has got enormous power, right? Let me give you an example of somebody who would have ended up purchasing an annuity in the year 2010. Maybe not willingly, may have been forced to buy an annuity because the corpus would have forced the person to buy. That individual would have purchased an annuity at that point in time, the rate was around 11%.
Okay.
Right? If I were to ask that person today, would you have bought more had you got an opportunity to? The answer would be yes. But that's today, right? 14, 15 years after having bought that annuity, right? So you have to look at it from a next 10-year perspective. While I think we must certainly give the benefit of doubt to the investor, to the individual, and say, it's your money, you should be free to do what you want to do. But I think for a very large number of people, what ends up happening is that when there is this large corpus that comes in your hand, you may end up investing it, or it might get used for things that you don't intend to. Therefore, in some sense, forcing the individual's hand to make sure that you are able to guarantee a certain cash flow for the life of the individual, I think there is merit in it, right? I mean, free marketeers, so to say, could argue that, you can't force an individual, but I think that debate is for another day. But I genuinely believe that, for a country like India, at the stage at which we are in, I think there is benefit, there is merit in annuitizing.
Got it. Second question, what is the difference between NPS and UPS, Unified Pension Scheme, since there's a lot of chatter about it recently, as it got applicable for central government employees with effect from 1st April 25.
That's correct. So the genesis of UPS is obviously the fact that the government felt that there was a need for them to. There was a lot of central government employees and of course in some state governments as well. There was a demand, or there was this ask that, you need to guarantee our pensions, right? One of the things about NPS is that the annuity rate is not known, right? The annuity rate is when you retire at that point of time, whatever is the corpus, you need to buy an annuity at that point of time, right? And therefore, the whole OPS product which was there till 2004, which actually old pension scheme, which got replaced by NPS, and I think they had tremendous foresight. I mean, at that point of time, the team that really sort of got this going had tremendous foresight. Otherwise, India would have been in a fiscally unsustainable position today. And countries which have not taken a hard look at their pension plans and which have remained defined benefit old pension scheme are really, staring at a very, very dark future, right? I mean, it can actually pauperize the next generation if you don't manage it. I think so. India, was from a timing perspective, we were really, really well placed to have that kind of people at that point of time who really thought through this problem and said, we have to take this hard call and implemented it and even though there was a change in government, if you remember, there was a change in government from, BJP to, the UPA to NDA or NDA to UPA, I don't recollect now.
NDA to UPA.
Despite that, right, the next government said, we need to implement it because this is the interest of the country, right? So there's a fantastic podcast on this where Dr. Ajay Shah talks about this, how this transition, he was a part of the OSS committee. Fascinating episode, which I'll share the details with you, after this. So essentially, so therefore, there was this thing that, we need to have visibility on how much pension we will get, right? That's the genesis, right? The government set up a committee in 2023 under the chairmanship of Mr. Somnath, who was the finance secretary at that point of time. And of course, there were a bunch of people from the finance ministry and of course from PFRD who were a part of it. UPS, or Unified Pension System as it is called, Unified Pension Scheme as it is called, is subtly different from NPS. Essentially, what it does is that the amount of contribution that goes into NPS is 10% plus 14%. 14% is what the government contributes, 10% is what the individual contributes. So there's 24% contribution that goes into NPS. Under UPS, there is a 10% that the employer or the individual puts in, 10% that the government puts in. So there's 20% that is going into the UPS account, right? And then there is an 8.5% that is going into a pool, right? And explain what the pool will do. So that's the nature of difference in terms of the contribution that is going in, right? Secondly, under UPS, what is the difference? The difference is that if you continue to contribute in UPS, right, and if you choose to move to UPS, you can choose as an employee to move from NPS to UPS till 30th of June. That's the deadline for you to move from NPS to UPS. If you choose to move to UPS, at the time of superannuation, if you've completed 25 years of service, right, you will be eligible for 50% of your last 12 months average basic.
Okay.
Right? Irrespective of the corpus that you've been able to accumulate, you will be eligible for 50% of your last 12 months average basic salary. Plus there is some lump sum amount that is also made available to you. And this will be adjusted for inflation every 6 months. This payment that will be made, this pension payment that will be made, will be adjusted for inflation, dearness relief as it is called, which is applicable for old pension scheme beneficiaries as well, right? So that's what UPS is. Essentially, accumulation journey. The customer ends up contributing 10%, the individual ends up contributing 10%, the government, that I explained to you. You stay in employment for at least 25 years, you're eligible for 50% of your last drawn salary, average last 12 months, and there is a dearness relief component on top of that. So that's really UPS. There are other, nuances which are there, which may not be fully relevant to what we're saying, but that's really UPS. In NPS, it obviously, the contribution amounts are slightly higher in the NPS perspective, and it gives you a lot more flexibility, right? In UPS, what happens is that the way it is structured at this point of time, if you got into the government employment at, let's say, at the age of 25, and if you want to keep the option of exiting from the employment at the age of, let's say, 40, 45, 50, you want to join the private sector, UPS pension will only start at the age of 60.
Okay.
Right? So it takes away from the flexibility. That's one, right? The second thing is that, there is this flexibility at the time of superannuation in NPS to buy a annuity plan with return of purchase price, right? While in case of UPS, what happens is that the corpus that gets accumulated on superannuation goes into the pool fund, which will keep paying your annuity or paying your pensions for your lifetime. And to the spouse, 60% of what gets paid to you to the spouse till the spouse is alive. And then that's the end of it, right? So the corpus does not come back to the next of kin. So that's the other difference between NPS and UPS. In NPS, you can end up buying a return of purchase price annuity, where post the demise of the primary and the secondary annuitant, the corpus can come back to the next of kin. So there it is also, in some sense, a succession planning tool. That flexibility is not available in UPS.
Got it. So speaking of underlying, where is the money invested?
Exactly the same. So in terms of the UPS, Gazette notification that got published before the launch of before it got offered to employees on 1st of April, the Gazette notification talks about essentially four options actually. One is what is called as the default option. Under the default option, up to 25% will get invested in equity. The remaining 75% will get invested in fixed income. Fixed income is corporate bonds and government securities, right? So that is what is called the default option under UPS. The non-default option under UPS are very similar to the non-default option under NPS, which is LC25, which is the conservative scheme where 25% allocation happens to equity, and it starts tapering to 5% from the age of 35 to 55. LC50, where 50% allocation happens to equity, and then it starts tapering off to a level of 10% at the age of 55. From 35 to 55, it drops from 50% to 10%. So the options available in terms of fund management on both are exactly the same, right? In UPS as well as in NPS. And the default scheme is the 25% option that I spoke to you about.
But if I'm going to get a fixed amount every month after retirement or whenever I retire, how is this allocation going to make a difference?
Well, if the default scheme is what you chose as a UPS subscriber, if you've chosen the default scheme, then it makes no difference to you, right? But if you said that, okay, but I want to manage my money to get managed a little more aggressively. Let's say you chose LC50, right? And thereby you got a higher corpus, right? Compared to what you would have had you remained in default, the excess over what you would have got in default comes back to you.
Okay.
At the time of superannuation. So to that extent, that's the extra that you get.
Okay.
That's the reason why you may potentially choose to go for an LC50.
So for a conservative investor, like who is more on the conservative side, but also believes in the power of equity.
Yeah.
Maybe it's a lesser riskier option than NPS.
Well, NPS also, you're right. So NPS, there is no guarantee of a last 50% of the last drawn salary, 12 months average. But in UPS, it exists. And to that extent, you could say if you're the jury is out because, we're still seeing trickles of, central government employees starting to adopt. I think it could change over the next 30 odd days that, is still there for people to opt. But the jury is really out. We really don't know, how many people are going to choose UPS because there are, people want to compare, contrast, figure out what is it that works for them. And also keep in mind that in the last 20 years, somebody who has remained in NPS, let's say 2004 onwards, if somebody has been in NPS and at a middle or a senior management in the government ecosystem, the corpus that they would have accumulated would be reasonably large, right? And they want to, which they may not want to let go into UPS at this point of time because on superannuation, it gets subsumed into the pool fund and, all the individual is eligible for is the 50% of the last drawn salary. So that's really, so we'll have to wait and watch how it goes.
Speaking of pension landscape, like it is compulsory for government employees to contribute, right? But it's not so much the case for private employees.
Yeah.
Can you compare a few developing countries examples or even that of the developed countries around how pension system works over there versus in the case of India?
Sure. See, the pension problem, so to say, is not unique to developing countries, right? Developed countries have been as, seized by this problem as we have been over the last few years. But I think what's happened globally is that there are, of course, shining examples of economies which have been able to sort of implement a system which is, really sort of helped them get there, make them, nobody is a fully pensioned society, I would say, but, getting on the road of becoming a fully pensioned society. In fact, the government's stated intent is that by 2047, India should become a pension society. We are a long way away from there, but that's the stated intent, and therefore the government is also sort of wanting to do a lot of policy measures to drive adoption of pension products in India, right? Coming back to your question on global examples of developing countries, I think amongst developed countries, I think clearly Australia, Netherlands, right? US has had mixed experience, but I think the standout are really Singapore, Australia, Netherlands, and some of these countries have really sort of been able to crack the pension system. It's a combination of universal basic pension, which is made available, and a contributory pension, which in many cases is made mandatory, right? In places like Australia, it's actually mandatory for you to contribute towards pension. And of course, there are some tax breaks, the costs are low, and it's market linked, right? So these are all countries which have really shown the way as far as a solid pension scheme is concerned, right? Now, if you look at developing countries, I think Chile is not really a developing country. It is a developing country technically, but the income levels are much more than India. I mean, it's got a per capita income, I think GDP of around $16,000, which is significantly higher than what it is in India. But having said that, it is still a developing country. Malaysia has had a good experience. Some of these countries have really sort of been able to build. In fact, Ghana is another example of a country which has seen reasonable success on adoption of pension plans. What's worked here is essentially the fact that you make it mandatory, right? In many cases, it is mandatory in formal employment. The challenge is in informal employment, right? How do you force an informal employee to adopt a pension plan where the nature of income itself is uneven, unstable, unpredictable, right? So that's where the problem lies, right? So if you're able to address that problem, and India has a massive sector which is unorganized, so to say, right? I mean, the informal workforce in India is 9-10 times the formal workforce in India, right? So to that extent, it's a significant problem in India, right? But why? So what distinguishes? What are the features of a good pension plan, right? Essentially, it needs to do 3 or 4 things, right? One, it needs to ensure that there is adequate coverage, right? Second, it needs to make sure that it is sustainable, right? Third, it has to have the integrity. The system has to have the integrity, right? If you're able to create a pension plan where you're able to make sure that it is available to a wide swath of masses, right? By making it mandatory, by making it attractive, tax attractive, by making it accessible to people, because mobile phones have become very ubiquitous now. So how do you make sure that accessibility of this so-called, and keep it simple, right? The more moving parts there are to any financial product, it actually does harm to the product, right? So as long as you're able to keep some of these features in mind, keep some of these factors in mind, pension plans tend to work very, very well. And these are all the countries that I spoke about. These are some of the standout features. And if you look at their pension plans, that's how they are created, and therefore the adoption levels are much higher, the sustainability is much higher, integrity is much higher, governance is very, very good, and of course these are all market linked. They've all chosen to participate in markets, right? These are not some fixed guaranteed return products, right? So I think that's what makes these pension plans stand out. India, I think we've basically got, as I said earlier, there are 2 products which cater to the majority of this. One is of course NPS and the other is EPF, right? Between these 2 products, and I'll talk about NPS, I don't want to really go down the path of EPF. We all are familiar with EPF and the fact that it guarantees a certain percentage and so on and so forth. If you look at NPS, the way it is structured, I think it addresses all of the needs of a very, how do you run a product which can really sort of, address this problem. I think it's a great vehicle, but we need people to get into that vehicle. For it to really for us to take India from being a, not so great in terms of its pension. Our pension assets to GDP, by various estimates, are between 7 and 14%, right? I mean, it depends upon what denominator you take, but it's in the region of numerator you take. It's between 7 and 14%. Its pension assets to GDP. While countries like Chile would be in the 60s, Malaysia I think is in 70s. Developed countries are upwards of 100%, right? So it's an indicator of how much of assets have been created or how much of pension assets are there with respect to vis-a-vis the GDP, right? So that's really, so we are a long way away from becoming a fully pension society. If you get to around 70-75% is when your coverage would have been reasonably good, right? Which is the reason why you've been able to create such a large corpus.
At what rate are the pension assets growing in India currently?
So if you look at the last 3 years, in India, NPS, NPS has been growing at the rate of roughly, we've been adding around 10 to 12 lakh subscribers every year, right? In the last 3 years, we've added around 31, 32 lakh subscribers, right? Today, the base is around 67, 68 lakh subscribers, and we're talking about the non-government space, right?
Okay.
So it's grown from around 40 to around 70 in the last.
No, it's almost doubled. The AUM.
Under assets under management, we are at around 2.8 lakh crores. At that point of time, it was, I think, around 1.3, 1.4 lakh crores. So it's doubled in the last 3 or 3.5 years.
For the private,
of course, the market impact, but also there is incremental contribution. The contribution levels have really, really, really gone up in India now, right? So last year, and this is an estimate, I don't know the exact number, the estimates would be upwards of 90,000 crores only in the private sector. The government sector is significantly larger, right? In the private sector, close to 90,000 crores of net inflows would have come into the pension funds.
So why I was trying to ask this question was to understand at what pace is the GDP growing versus at what pace are the pension assets growing?
Pension assets are growing faster than...
much faster,
much faster than GDP, without a doubt. But it's just that the base is very, very small.
Right now. Right, so for NPS, if we have to calculate at a 4.1 trillion level dollars of GDP, it's close to 4%. If we add...
Well, yeah, that's right.
If we add EPF and, APY, we are close to 10%.
That's
10-12%,
That's right. That's right.
So if we have to reach a number of 70%, that's like... That's a far call, right?
That's right.
7 times from here.
That's right.
350 lakh crores, right? So when do you think that can happen? By when?
It's a tall order. I don't think we should run away from the fact that it's a difficult problem to solve.
Absolutely difficult.
But I think if you're able to address 2-3 things, right? I mean, what is it that ails India, right? And if you look at, so as I said, the vehicle is fantastic, right? Now we need to make sure that people are able to participate in this vehicle. How do I make them participate in this vehicle? To be able to firstly make sure that there is significant amount of time, energy and money that goes into making sure that we make Indians literate, right? It has to be a compulsory subject in high school, not even in college, right?
Financial literacy.
Yes, right? So financial literacy lies at the core of making sure that Indians understand some of these things, right? So one is you need to make them aware of the fact that this is something that you need to take seriously. Not just retirement planning, but financial literacy per se, right? I mean, enough and more people who roll credit card debt, right? I mean, it's unbelievable how people would be doing that, right? So essentially, financial literacy. Second, being able to make it accessible, right? And with technology now, right? The kind of technology that we now have, I mean, look at adoption of mutual funds have skyrocketed because of digital interventions, right? I mean, if some of the fintechs that have come up over the last 5-6 years have made sure that people are able to not just mutual funds, but even products that you may frown upon, right? I mean, for a retail customer who doesn't understand, their ability to buy and trade an F&O is a matter of a few clicks, right? So if it's so, how do you leverage that technology architecture to make sure that onboarding into NPS is simple? It is, by the way, at this point of time, it is very, very simple. It takes less than 3 or 4 minutes for you to open an NPS account, right? Thirdly, there has to be policy level intervention, right? Today, there is EPF, which is mandatory, and there has been a debate around NPS, EPF. Should NPS be mandatory, EPF be mandatory? I think both have their place in the portfolio. The government offers you the benefit of tax deduction on both these products, up to a certain limit of 7.5 lakhs under 80cc2 for a salaried individual. But I think one needs to evaluate as an individual, where is it that I want to contribute more? Which product will serve my needs better, right? If I have 30 years of runway, am I happy with an 8% or would I want to have a high probability of a double-digit return, right?
Right.
And the other thing is, when you look at the way Indians are, looking at this whole, wealth creation, so to say, things have changed, right?
Right.
But we've got a long, 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 long way to go. And I think we need to crack the problem of the informal sector, right? Salaried, there is a tax advantage, there is a flexi benefit under which this gets it's counted and so on and so forth. Even after that, we see a lot adoption levels being low. Therefore, the industry needs to do a lot of heavy lifting in terms of making sure that we are able to educate. And I think we are on the journey. At this point of time, we are sort of, and it is sort of, we would not say we have been, we've sort of shot the ball out of the park, but I think we have really, on a solid growth momentum last 3-4 years, and hopefully, that will continue.
So do you think that NPS contributions by the employer or by the employee himself should be made compulsory in the private sector as well?
Well, it's very difficult to make it compulsory, right? I mean, it's very difficult to take away from the, you're right. So even in employee provident fund, actually the mandatory requirement is that you need to contribute 12% of 15,000, right? Very few people are aware of the fact that it's not really 12% of your basic that overall you need to be contributing salary, as an employer. As an employer, I can tell my employer that, listen, cap it at 12% of 15,000, right? Which is 1,800 a month or 21,600 a year, right? Beyond that, I would want to start contributing to NPS, right? Now, it has to be a combination of nudge, compulsion in some cases, right? Like 40% is compulsory annuitization. We spoke about the 40% compulsory annuitization and why there may be some merit for that in India. Yes, there is some merit in, driving compulsory adoption. And we've seen companies being very progressive about this. Some of the companies actually offer incentives for people to start contributing to NPS. Open an NPS account and start contributing. They'll give a matching contribution, right? Which is, I think these are the ways to sort of make sure that adoption increases. The ecosystem and the architecture is fairly efficient at this point of time. The cost we all know is very, very low. Flexibility, we are all aware of the kind of flexibility that it offers. I think it's got everything going for it. We just need to make sure that there is some policy interventions that we're able to make, the government is able to make, which the government has been actively making. And every year there's a mention of something around NPS in the budget speech. And there's active involvement that the ministry and the regulator makes with the industry to sort of, for us to keep giving inputs to them in terms of how do we make it better and better and better and see more and more people adopting this product.
Any 3 key changes that you would want to recommend if we have to, improve this ratio? Any 3 key changes that you think should become a part of the NPS framework overall?
Well, as I said, and I'm going to repeat what I said earlier, right? One is we need to make sure that people are made aware of, and that's not an easy task. It will not happen in 1 year, 2 years. It's an ongoing task. Right? It's an ongoing task of making sure that people are aware of the fact that there are a multitude of products, but there is this product which can also significantly impact your financial future if you take the right steps at the right time. Second is, we spoke about policy level intervention. We spoke about EPF, NPS, right? As an industry, we do believe that there should be a choice that the employee should be able to make, which, as I said, is available to, as far as the employer contribution to the Provident Fund is concerned. You can redirect it to NPS. We are trying to bring about more awareness around that so that people know that there is a vehicle that has a probability of a double-digit return, because if you do the right asset allocation, it can actually significantly impact the retirement corpus that you can create. Of course, there will be different kinds of risk appetite. Some people may not want to take equity risk at all, and for them, there are options available within NPS as well, right? So second is that. And third is, how do we make sure that we are able to leverage this whole architecture around the whole adoption that's happened around tech? How do we make sure that we are able to drive more and more fintechs to become active when it comes to, and there are a few that have become quite active when it comes to promoting NPS. And I think if we do some of these things, and of course, as I said, the government continues to keep looking at this product from a balancing of cost versus, attractiveness perspective. And I think we are in a very, very, very good position at this point of time.
Got it. So do you think regular plans should also be introduced in NPS to increase its adoption? Because I know that's going to be more costly for customers and all. But for a larger adoption, if we have to say so, for the private sector, do you think there should be plans like that introduced for NPS?
Well, I think, there are different kinds of architecture that work, right? So when you look at NPS, there is a certain account opening fee that you're able to charge. Of course, there are caps around how much you can charge. There is a contribution fee that the customer pays, right? These are all fees that can actually get redirected to the distributor. Now, If you compare that to, let's say, alternative other products that the distributor would be offering to their customers, maybe it is not as large, right? But there are streams of income that can get created if you're able to create a large enough base of active NPS subscribers. This can be a meaningful source of income. Now, should this become AUM based? It's $1 million question. It results in higher cost for the customers. It's akin to your question on should there be a regular plan where there is a higher fee, because that can then subsidize the distribution. I think we need to keep this industry will evolve. I think we have been, as I said, constantly dialoguing with our regulators to understand what are the things that are, incumbent on us to make sure that this product we are able to drive. It's a combination of things. It's not just higher fees, but we understand that commercials is important. But it's a balance between commercials and making sure that the product continues to remain attractive. But that's certainly on the table, and I think it's above my pay grade to really talk about whether we should introduce a layer of cost on top of what the cost is. But I can tell you that all options are being evaluated to make sure that there is higher and higher offtake of this product.
Got it. Any closing note that you have for our audience?
I do hope that more and more of your advisors and customers that work with your advisors understand the power of this product and are able to sort of appreciate the fact that you should start, and you should start now, because this product is indeed magical.
So thank you so much, Sriram. It was a really insightful conversation for me, and especially around the pension assets to GDP ratio that we must be eyeing, and for that, what all frameworks that we need to adopt in NPS, especially making it largely mandatory for people in the private sector, and making it more making people more aware about it as well. So thank you so much once again. We are really grateful for your time.
Entirely my pleasure, Karan. Thank you for having me.